It's a real pleasure to have this opportunity to address the Global Game Changer Summit organized by ASIL at Penn. The topic today is going to be the future of ESG investing, maybe with a question mark. And the thesis is really going to be that we need to be careful not to throw out the green with the greenwash. I'm really thrilled to have this opportunity to share some of the latest work of the ESG Initiative at the Wharton School with you. The agenda today is to quickly, because I think everyone by virtue of being here is interested and somewhat knowledgeable about ESG, but to share a little bit of ESG 101 for you. What do you need to know to understand the broad area? Explain the amazing rise of interest in this topic over the last 5 to 7 years, try to put that in perspective. And also maybe over the last 7 months, put into perspective a little bit the criticism. What are some of the concerns? What are some of the skeptics saying? And why is this such a wedge issue in the 2022 midterm elections here in the United States? And then try to pull that together and chart a way forward. What should ESG look like in 2025? How do we get there? And then briefly talk about the role that the University of Pennsylvania and in particular the Wharton School's ESG initiative is playing in that process. So ESG 101 to start. Environmental, social, and governance factors, broadly known as ESG, are a set of non-traditional factors that still influence financial performance, but they influence it in the long term. And so what we're trying to do in ESG is capture short-term indicators that assess a firm's performance on environmental, social, and governance criteria that are argued to influence its long-term financial performance. How do they influence financial performance, you might ask? Well, the logic is that if a firm imposes costs on its stakeholders, if its externalities negatively influence the community, the workforce, or the natural environment, those stakeholders or stakeholders who are influenced, say, by the natural environment, might take action that hurts the firm in the future. So the more externalities you impose on others, the more risks you're taking on to shareholders. And the happier story is when you create positive externalities, when you create benefits for the community, the workforce, suppliers, the natural environment, hopefully that'll feed back into positive effects for shareholders. How does that work? Well, the reactions aren't going to be immediate. The reactions are going to be through the government, who might impose regulations or standards. They might be the reactions of stakeholders, say customers or suppliers who don't want to do business with the firm anymore if it's imposing negative externalities. Or it could be the reactions of your competitors who come up with a product that has fewer negative externalities or more positive externalities. And then that leads customers, say, to defect or suppliers to defect to them. Any one of those turns the environmental, social, and governance factors, which aren't thought of as having financial implications, into something that hits the P&L. Revenues, costs, or risks, and thus influences shareholder value. That's ESG 101. Now, what's behind the rise of ESG? First, just to document it, if we look at the Google Trends use of the term ESG relative to sustainability and CSR, we really are at an inflection point in 2022. For the first time, ESG is used more broadly and more commonly than either sustainability or corporate social responsibility. And if you do surveys or polls of C-suite executives, board members, investment managers, analysts, portfolio managers, consultants, strategists, they all report that the importance or their belief in the materiality of ESG has more than doubled since 2015. And not just doubled from a small base, but doubled from about 30 or 40% to 80, sometimes 90% of those populations saying they believe the financial case for ESG. Investors are also eager to invest in ESG-oriented products. According to the GSIA, the Global Sustainable Investment Analysis, the total pool of assets owned that is seeking ESG-oriented investment, that would like to incorporate ESG into its investment thesis, is $35.3 trillion. And that's growing at 13% per annum. And if we look ahead, that's going to grow even more because it's not just the growing in the general population, it's growing particularly among young millennials who are going to have an increasing share of the asset base over time. Why is this happening? And why in particular since 2015? Well, every January, Larry Fink, who's the CEO of BlackRock, sends a letter to every CEO of every company that he owns. That's basically every publicly traded company in the world. And he says what's on his mind. What's going to affect his investment decisions? What's going to affect his engagement with your company this year? And since 2015, he shifted from talking about governance and well-run companies to talking about ESG factors. First, purpose, then stakeholder orientation, long-termism, and most recently, climate risk as investment risk. And now he wants proof. He wants to know what you're doing to incorporate climate risk as investment risk into your strategy and into your business development. Another notable event in recent years was Engine No. 1's successful campaign to oust 3 board members from ExxonMobil, because not just ExxonMobil was destroying the environment, the major polluter of greenhouse gas emissions, but by not attending to the climate transition, they were destroying shareholder value and falling further and further behind their competitors in the oil and gas industry. Suddenly, every board member is wondering, do I have hidden ESG liabilities and risks that I'm not attending to? Could I lose my board seat because of an activist investor like Engine No. 1? Maybe I better learn more about ESG. For many years, when we would talk about the materiality of ESG factors, people would say, well, if that's true, why don't I hear about it in the analyst earnings calls? Why isn't it coming up in the quarterly conversations I have with my investors? Well, guess what? Starting in 2020 and 2021, it was. We now see about 20 or 25% of the analyst earnings calls of the S&P 500, including conversations around ESG. The issue has arrived. We're also seeing an increased sophistication of investor strategy in dealing with ESG. They're moving away from just screening or divesting, strategies that the academic literature suggests are somewhat suspect in terms of their efficacy, to more sophisticated strategies, including ESG integration, which means taking ESG factors and putting it into the profits and loss statements, adjusting the valuation according to ESG characteristics. And if you look on the bottom panel, you see that the ESG integration strategy is the most rapidly growing one from 2016 to 2020. And if you look at the top panel, you see it's the largest strategy overall. We're also seeing more and more money spent on ESG data. We're now spending up to $1 billion per annum on ESG data. Now, that's still only a small fraction of the $12 billion we spend overall on financial data, but it's expected to rise to over $5 billion by 2025. And the growth rates are really massive. So people are spending more to understand what's going on. With all that good news, what's all this skepticism about? What is the anti-ESG movement? Let's unpack that. First of all, we've got to be honest. The data is poor. If you look at the correlation in bond ratings or credit ratings from S&P, Moody's, and Fitch, it's 0.9 or 0.95. If you look at the correlations among ESG ratings from the major data providers, on average, across ESG as a whole, it's 0.4 to 0.5. But if you drill down to the E, the S, or the G, you're talking about 0.3, 0.2, or maybe 0.15. Is Apple a good company? Well, some raters say it's in the bottom 5%. Other raters say it's in the 95th percent. What about Amazon? From the 10th to the 80th? What about Berkshire Hathaway from the 2nd to the 60th? If the answer to is a company good on ESG depends on who you buy the data from, we have a real problem in proving the business case and adjusting our investment theses accordingly. And that's exactly the problem that the asset management space is currently experiencing. There are 428 funds on Morningstar as of 2020, which self-identify as having an ESG orientation. On the horizontal axis, we plot the tilt to or away from ESG. Now, it's a little encouraging that the average ESG labeled fund is actually tilted to the right, to the right of zero. It has a positive tilt in the ESG direction. It's a little disturbing, however, that there's such a large number of funds to the left of zero, which market themselves as ESG funds, but actually are below their benchmark in terms of the ESG performance. What's also disturbing is that if we look on the vertical axis, which is the returns relative to the benchmark, we see that moving to the right lowers your returns. So despite the rhetoric, despite the logic that climate risk is investment risk, the more we tilt towards ESG, the more we're lowering our baseline alpha relative to the benchmark. This gives rise to a lot of concerns about what's called greenwashing. Firms claiming that they're doing something that has an ESG orientation, or a fund doing that, but actually not really changing their practices, just painting over the smokestack screen, as you see here. And that is a real and legitimate concern, and we're doing research on that in the ESG Initiative and trying to call people out and call fund managers out that aren't serious about their ESG strategies. But this is giving rise to a broader set of concerns around the ESG movement. Tarek Fancy, formerly head of sustainability at BlackRock, calls out the hypocrisy of ESG investing, calling it a dangerous distraction. And academic colleagues, including Andy King at Boston University and Bocconi, have called out the heroic accounting. And is it sales or is it substance? How much is this real? Their arguments are that it's hopeless to make progress on the data problems. It's a distraction from government regulation. And in fact, it's the financial service and the corporate sector trying to protect itself against more stringent regulation. I disagree, but I have to admit that their concerns and their criticisms of the data and the analysis getting far ahead of reality are true. Now, there's another set of voices joining the ESG critiques right now. And this has happened over the past couple months, and it's really disturbing. Whether it's Ron DeSantis, Ted Cruz, Peter Thiel, Elon Musk, Tucker Carlson, Mike Pence, we are seeing a pushback against what's called woke capitalism, where coastal elites dictate the terms of investment strategies to pension funds of middle-class voters in middle America. At least that's what they claim. But let's really look at the two sides here. One side says climate risk is investment risk, and we should be attending to the concerns of climate risk and when we're making our investment decisions. What's the logic here? Climate risk isn't investment risk. We can't do business with financial service companies that take climate risk into account. That's the strategy of the anti-ESG movement. And I'm really puzzled as to the logic. And I'm really puzzled as to the end goals. The logic doesn't hold up. The research doesn't back that not taking these things into account is a good idea. As a result, I have to conclude, especially if you look at who the funders are, which are the same funders of climate denial, that this is essentially a political stunt designed to be a wedge issue for the 2022 and maybe the 2024 elections. And I'm really frustrated by the media inquiries I get asking me who's winning, the ESG movement or the anti-ESG movement. Let's look at the data. I'm an empiricist. $35.3 trillion wants to invest in ESG. There's about $4 trillion that actually is. The anti-ESG funds, $400 million. They also charge dramatically higher fees than funds that do exactly the same thing that have been around for some time, making me wonder if it's more of an Alex Jones or Donald Trump kind of stunt to raise money rather than a substantive investment thesis. ESG shareholder proposals on average receive 30 to 40%. Anti-ESG proposals, 7%. 27 red states are now banning their state agencies and municipalities from doing business with financial institutions that take climate risk into account. What are the implications of that? Well, our own Daniel Garrett at the Wharton School has shown that has cost state of Texas taxpayers already between $300 and $540 million, and those costs are only going to increase over time. While these are real financial costs to BlackRock and other asset people who might issue these bonds, the costs are far less than ignoring climate risk. So what's the path forward? How should we be thinking about ESG? We need to go back to the profits and loss statements, and we need to go under the surface of the water, if you will, and look at all the ways in which stakeholders change the revenues and cost structure of a firm that we don't include in our financial models and we don't include in our project valuations. We've got to get real about thinking about the pathways by which ESG factors hit revenues, costs, and efficiencies. For example, the physical and transition risk of climate leads to changes in behavior by businesses and households, which leads to a set of risks for businesses. It also leads to a suite of opportunities in the green tech and other environmentally friendly spaces. Similarly, labor practices, the way we treat our workers, the degree of diversity we have, the work from home policies, the daycare we provide, the other facilities that enable people to work who have family or health constraints, those change the productivity, the engagement of the workforce, and they change the outcome of the firm in terms of its performance. We're kind of following this logic, or we are following this logic as we build up a framework for investing called the Total Value Framework. And I was the lead consultant working with Engine Number One in developing that and scoring the entire S&P 500 in terms of the total externalities they impose on companies, how likely those are to drive shareholder value, and showing that that's a profitable way of analyzing companies and deriving a portfolio for investors to follow, or a strategy for engagement with a broader index of funds like the S&P 500. So in response to some of the criticisms, at least the ones that aren't a political stunt, let me ask the question: is it time to roll up our sleeves and do battle over some of these issues, to really do the analysis to show that ExxonMobil is destroying shareholder value and destroying the climate? Or is it time, as Tarek Fancy did, to walk away from BlackRock and become a political pundit? I think, and I side, and I have explicitly sided because I'm an advisor for Chris James at Engine Number One, with the former argument. This is not a time to walk away. This is not a time to give up. It's a time to roll up the sleeves and do the hard work. That's what we're doing at the ESG Initiative. Consistent with the founding mission of Joseph Wharton, we're trying to prove that business and capitalism can be a force for good and can solve the social problems incident to our civilization if we give it the right data and the right tools to do that. What does that look like? It means doing the research, rolling up our sleeves, and actually figuring out where, when, how, and how much ESG factors matter. Who's spending too much? Who's spending money on the right thing? Who's spending money on the wrong thing? Bringing that into the classroom for Wharton undergrads, MBAs, Penn students, and executives who come to campus, both curricular and co-curricular experiences, and then through our industry research partners and through the people who work with our students, either after they leave or while they're here on co-curricular experiences, shaping industry practice. We have 43 partners who are working with us on our research, on our student programming, and these are some of the leading companies in the world who are trying to make progress in ESG integration. We've already launched an MBA major and an undergraduate concentration in the ESG space, the first business school to do that. We have 4 new executive education programs being launched in 2023, and we're dramatically expanding the scope of co-curricular experiences for our Wharton students as demand skyrockets for practical real-world opportunities to apply these skills while they're still students here at Wharton. That's what I've got today. I hope it was an inspiring kickoff for the rest of your event, and wish you the best over the Global Game Changer Summit. Thanks very much.